Welcome back to the show. My name's Mark Nixon. Oh boy, our top story today is Canada's economy. In just 24 hours, we got two massive reports. First, the Bank of Canada, and today we got Canada's jobs report. It's not elbows up, it's buckle up, Canada. Let's get into it. Let's go. We're going to start things off with the CTV News report.
It's April's job numbers. It says the economy added 7,400 jobs, but that wasn't enough to keep that unemployment rate from rising for the second straight month. It's now at 6.9%. The increase in the jobless rate suggests employers aren't hiring as quickly as the population grows. Canada's manufacturing sector shed 31,000 jobs as tariffs from the United States hampered the industry. Offsetting that loss was a jump in temporary employment connected to last month's federal election.
Yeah, and we're going to get into the numbers because the federal election employed 37,000 people and it wasn't, it propped up these job numbers. Our jobs numbers are not looking so hot. Canada's unemployment rate has jumped to 6.9%. This is the highest level since 2016, excluding all of those lockdowns. We are going up, and get this, 37,000 of those jobs were temporary election hire in public admin. Translation, next month, those jobs are about to vanish, and the film industry employs nearly 250,000 people. What are we going to see happen with those 100% tariffs that were announced earlier this week? Maybe, just maybe, they're going to have to cut interest rates by 0.25 in June, because before they hadn't even thought about cutting interest rates. But with this jobs report, they might be forced to cut. And as you can see, the Canadian dollar took a dive as soon as this jobs report was released. Take a look. We were at 72.5 and now we're at 71.76. And here's a graph that was released by the Bank of Canada yesterday. The blue area is the projection. And as you can see, this is mortgages in arrears, meaning that mortgages that are going into default is expected to skyrocket back to levels we haven't seen since the 1990s if this thing plays out. Black line in the past, and like I said, the blue line is where the future is going to be. The Bank of Canada traditionally are more conservative than they don't want to set in any panic. So they're not going to be aggressive in the way that they're forecasting this. Yes, they provided a big window, but take a look. We could be way worse than 2008, 2009 financial crisis. And it could be comparable to the 1990s recession, in which we saw a decade of real estate values declining for 10 straight years. I don't know if that's going to be what's going to happen in Canada, but we already have seen prices come down from peak 2 years ago. The last interest rate announcement, Bank of Canada did nothing. They paused. Everybody thought they would at least cut by 25 basis points after they cut interest rates for 8 consecutive interest rate meetings. But now that we got this jobs report, it's nearly baked in now that they're going to be cutting interest rates by 25 basis points on June 4th. And guess what? The US this week decided to pause cutting interest rates. The Bank of Canada, if they do decide to cut interest rates, that will affect the Canadian dollar. Here's what the unemployment rate looks like across Canada in each province. But you're going to notice that Ontario is at 7.8%. And this comes from the Bank of Canada's report that they released yesterday. The trade war increases the risk of disorderly market sell-offs. Continued U.S. trade policy uncertainty could spur further market volatility and an abrupt repricing of assets, which in turn could lead to acute and persistent liquidity pressures that tests the financial system's resilience. And this one is the most terrifying one. The indicators related to high house prices. House prices have climbed considerably since the start of the global pandemic. Expectations of future price increases and strengthened investor demand likely contributed to this rise. A large misalignment of those house prices relative to longer-term market drivers could lead to an abrupt price correction in the future. Such correction can in turn bring in financial stress for households because housing often represents their largest assets. Here's the thing. This is not a Donald Trump thing. This has been in the works for over a decade. Our system continued to leverage and reduce interest rates so people would borrow more and more. Everyone in Canada, not everyone, but many people are over leveraged. And with these higher interest rates and the over leverage, and also with jobs, unemployment rates going up, this is what the Bank of Canada is worried about. And also, there could be a liquidity crisis, meaning that when people go and try to secure a new mortgage, they're declined even though they qualify for the mortgage. That is what is concerning. I want you to pay close attention to this news release that occurred yesterday by Carolyn Rogers.
12 months, particularly in households without a mortgage. For example, the share of these households that are behind on credit card or auto loan payments has continued to go up. Among households with a mortgage, about 60% are facing renewal this year or next. Most of those renewing will see their payments rise because they took out their mortgage during the pandemic when rates were at historic lows. But the average increase in payment will be smaller than we expected a year ago. Still, if a large shock causes job losses, it'll be harder for some households to keep up with their debt payments. A prolonged trade war may be that shock. It would cause demand for Canadian exports to fall. It would disrupt supply chains, threatening jobs and incomes. Workers in trade-dependent industries could find it particularly difficult to continue managing their debt. A prolonged trade war would also matter for businesses. Most Canadian businesses have managed to adjust to past interest rate increases, and the surge in small business insolvencies last year proved to be temporary. But businesses in trade-related sectors, especially those with high debt, low profitability, or cash reserves, could also fall behind on debt payments. But if credit losses occur on a large enough scale, banks could cut back on lending in response. Struggling households and businesses would then have less access to credit to get through tough times. This cycle could exacerbate the economic downturn. In the non-bank financial sector, the growing presence of hedge funds in the market for Government of Canada bonds raises some concerns. Government bond markets are the foundation of the financial system, and they need to function smoothly for all other markets to work well. The increased activity by hedge funds has helped absorb increased issuance of government debt, keeping yields lower and liquidity higher. But hedge funds have also taken on increasingly large amounts of leverage to fund their purchase of government bonds. And this makes them more likely to pull back from these crucial markets in periods of stress, introducing added volatility. The recent gyrations in the U.S. Treasury market clearly illustrated this risk. If the trade war causes a larger spike in volatility than we've seen so far, leveraged hedge funds might rush to sell their holdings. That could strain liquidity across core markets, increasing stress throughout the financial system.
I want to explain what she was talking about at the end there. If there is a sell-off of Canadian bonds, what will happen to the price? The interest rate will actually go up for the fixed-term mortgages. For example, if there's a mass liquidity sell-off, the rate right now is, let's take a look at the rate. So the 5-year GOC is 2.772% today. And how mortgages are priced is usually 100 basis points, so 1% more than this posted rate. So it's just under 4% today. But if there's a massive sell-off, this would spike the 5-year GOC, resulting in it going up in price, meaning that not only will people have to renew at most likely double their current rate, because 60% of mortgages are renewing in this year or next year. And if they renew right now, they're renewing at twice the amount. But if it goes up even further, it could be even harder for these Canadians. The thing is the Bank of Canada is probably doing a warning, because they might have to come in and inject billions upon billions to push down the yield. So what they'll do is they'll turn on the printing press. We're going to find out what they're going to do. For all the people that want to blame Donald Trump for all of this, this is the unemployment rate for United States and Canada adjusted to US concepts. The light blue line is the United States and the dark blue line is Canada. And as you can see, Canada is suffering from more unemployment than in the United States. Economically, we're in a different position. And I want people to see this statistic. Between the ages of 25 and 54, we brought in more than 500,000 people to Canada in the last year. And look at the full-time employment, only 182.7 thousand jobs. Part-time is 50,000. Look at how many people are unemployed. Yeah, it's not looking good. This is a shorter update because there's going to be many more updates. This is a rapidly materializing situation. When the Bank of Canada comes out with more information, I'm going to provide all of you an update. I'm also going to be keeping track of the 5-year GOC to see where mortgage rates are going to be going in Canada. I will be reviewing future jobs reports and provide updates on my channel. So make sure you subscribe, like this video if you enjoyed it, and leave a comment. I'll see you on the next report.